Welcome to The Explainer. Today, we're exploring the structural blueprint of how companies actually get the money to launch and grow. Uncovering this architecture honestly felt like finding a master key to the business world. Together, we're going to trace exactly how an idea goes from just a quick sketch on a napkin to a fully operational enterprise. And spoiler alert, it's not just about the money itself, but the strategic leverage behind it.
Okay, let's dive into this. Have you ever wondered how people start businesses even when they don't have thousands of dollars sitting in their bank account? We constantly see these massive new startups scaling rapidly, right? But how exactly is that initial capital structured when a founder doesn't have a small fortune on hand? Well, the answer isn't magic. It's a highly structured system of leverage. We see it in the headlines every single day. Maybe a local brand suddenly goes nationwide, or a tech startup captures millions of users, literally overnight. It really all comes down to understanding the financial mechanics hiding behind the curtain.
Let's kick things off with Section 1, the financing foundation.
Just as a quick level set here, business financing is essentially money a business receives from outside sources, like banks, investors, or special programs, to start, operate, or expand. It's all about strategic leverage. The goal is to shield your own personal savings while securing the external fuel the business needs to scale sustainably. It's basically the art of using external resources to accelerate your growth timelines, hitting milestones in months that would otherwise take decades to achieve organically.
Next up is a major crossroads for any founder. Section 2, debt versus equity.
Now, what's really interesting about this slide is the massive trade-off between these two options. On one side, you've got debt financing. This means borrowing money and repaying it over time with interest. The catch, regardless of your success, that money is absolutely owed. But the huge upside is you get to keep full ownership. On the flip side, there's equity financing. This is where you give investors a share of the business and future profits. You avoid the heavy drag of mandatory monthly loan payments, but you do give up some control and ownership. It's the classic founder's dilemma, right? Do you want to own all of a smaller pie or a smaller slice of a massive one?
Let's look at the actual toolkit. Section 3, 6 sources of capital.
Here is your roadmap of the 6 most common financing sources available in the US. We're going to start close to home with personal savings and friends and family, scale up to traditional institutions with bank and SBA loans, and finally reach the high-stakes world of angel investors and venture capital. Let's break down each tool and, more importantly, figure out when it makes strategic sense to actually use them. Number 1, personal savings. Bootstrapping with your own capital is pretty much the ultimate flex in early entrepreneurship. Why? Because it's fast and requires absolutely no approval. There's zero red tape, no pitching, and no waiting around for credit checks. You control the funds, so you can execute your idea immediately. A lot of the most resilient companies start exactly here, entirely self-funded, mainly because it forces a lean, highly efficient business model right from day one.
Number 2, friends and family. Now, when bootstrapping just isn't quite enough, founders often tap their inner circle. You're raising money from people who trust you and believe in your vision. It's a vital early funding bridge, though, it does mix personal relationships with business risk way before institutional players are willing to step in. It's a powerful validation step for sure, but it absolutely requires deep transparency about the potential risks involved.
Number 3, bank loans. Okay, this is where we cross into the institutional realm. Traditional financing. Banks aren't investing based on a shared vision or family ties. No, they require cold, hard proof. They demand strong credit, flawless financial records, and a rock-solid business plan that proves you can reliably handle those mandatory monthly payments. It's a fantastic way to scale without giving up equity, but the barrier to entry is entirely based on your financial discipline.
Number 4, SBA loans. And this brilliantly illustrates how the system actually de-risks the process for smaller players. These are backed by the U.S. Small Business Administration, meaning the government guarantees a portion of the loan. Because of that safety net, approved lenders can offer lower down payments and favorable terms that a traditional bank wouldn't dare offer a brand new company. It's essentially a government-backed bridge designed specifically to fuel economic growth right at the grassroots level.
Crossing back over into equity, we hit number 5, angel investors. These are high net worth individuals investing their personal funds into promising startups. But the real secret here? It's rarely just about the cash. A great angel brings mentorship, guidance, and a deep, elusive industry network that can completely alter a young business's trajectory. Honestly, getting the right angel investor can be a lot like bringing on a veteran co-founder who already knows exactly how to navigate the specific hurdles of your industry.
Finally, number 6, venture capital. This is the heavy-hitting equity option. VC firms pool large amounts of money to deploy into high-growth businesses in exchange for equity ownership.
but they are exclusively hunting for massive, highly scalable growth potential, the future unicorns. In exchange for a significant chunk of equity, they provide the rocket fuel needed to build a global giant. The expectation here isn't just to build a profitable local shop, it's to fundamentally disrupt entire markets and deliver huge exponential returns.
Let's move to and see how this builds. Section 4. The Investor Checklist.
Before any lender or investor unlocks the vault, they need to answer 4 ruthless questions. 1. Is there a strong plan? 2. Can it generate profit? 3. Is there an experienced owner at the helm? And most critically, 4. Can the business actually repay the financing? If those answers aren't a resounding yes, the vault stays closed. It really is that binary when you're dealing with institutional capital.
To verify those answers, lenders demand tangible proof. They examine your cash flow, scrutinize your credit history, look at your available capital, and check your collateral, basically assets they can seize if things go south. They are looking for verifiable data before approving anything. The narrative and passion of your business might get you in the room, sure, but the cold, hard math on these documents is what actually gets the deal signed.
Which brings us to our final wrap-up, Section 5, the blueprint for success.
So the crucial point is this core philosophy. Financing doesn't create a successful business. A successful business uses financing as a tool to grow faster. Piles of cash simply won't fix a broken business model. Smart founders build a profitable foundation first. Then they use financing strategically, literally like pouring gasoline on a fire, to scale operations, hire elite talent, and multiply their revenue. Understanding this distinction is really what separates sustainable empires from those flashy startups that just quickly burn out.
We now have the complete blueprint for American business financing. We've weighed debt against equity, explored the 6 key capital sources, and cracked the investor mindset. Now that you understand the tools of business financing, what idea will you turn into a real company? The capital is out there waiting for you. Thanks for joining me for this explainer, and keep learning.